Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin with our top story. Stocks sliding going into jobless claims at 8:30 Eastern Time. Seema Shah of Principal Asset Management thinks it will take a lot to end this bout of volatility. Unfortunately for markets, the negativity of the current narrative implies it may take a combination of solid economic data, earnings and reassuring Fed speak to settle nerves. Seema joins us now for more. Seema, let's take it from the top then and go through it point by point. The Federal Reserve, the Fed speak, the earnings and the data. Just where are we at the moment?
We haven't got that much. Unfortunately, there's not much Fed speak between now and Jackson Hole. I'd expect a couple more speakers to be coming out to calm the market. The thing is that, just as we are all reacting to the economic data as it comes out, that is also the case for the Fed. So they can tell us that things don't look so bad. They can reassure us that the labor market doesn't, the payrolls print of last week is just one data point. But of course, if you were to see a continued deterioration in the data, well, the Fed themselves are going to have to respond in kind.
What is driving things here, Seema? What's amazing about this shock of the last week, if we can call it that, is for many people, they're still trying to diagnose the origins of it. Is this a growth scare born in America or the vicious unwind of the carry trade out of Tokyo, Japan? Where do you place the greater emphasis?
Well, I would say that, look, for the last 6 weeks to 2 months, I have seen the number of client queries moving towards worrying about actually recession has been quite surprising. So we've moved away from wondering, is the economy going to continue to accelerate? Is there an overheating? To people really questioning how weak the economy is. So in a way, I do think this is a growth scare. I don't actually buy into it, but I do think a lot of it is born of a growth scare. And then it's been exacerbated by this very, very low liquidity. I think the three of you are the only ones left in New York this week. So that hasn't helped. And then, of course, there's positioning the carry trade. So it's been a bit of a perfect storm of events. But I think that the growth scare has actually been building up in people's concerns for a while.
Seema, what does that mean for the data coming in, not just this week? John went through the calendar, PPI, CPI, and retail sales next week. Are you worried?
I don't think I'm worried because I think when we look at the breadth of the data, we do believe that there's still a lot of resilience, particularly in household balance sheets and corporate balance sheets. And what that should mean is that if you were to see a deteriorating labour market, it shouldn't then mutate into a hard landing. But we have to also be aware that job losses can be quite self-reinforcing. Job losses lead to further job losses. At this point, though, we're not seeing layoffs. And a lot of the surveys that we're looking at and just kind of watching companies and how they're reporting, you're not really hearing news of that. But of course, the Fed has to be aware that, look, the labour market deterioration, if it continues, well, then that could feed and create a downward spiral. I think that the CPI data, for the first time in ages, that's not the front and centre. It's really about the growth data and in particular about the labour market.
Seema, let me actually ask that question another way. Are you worried about the market reaction? Are you worried that this is a market that is putting too much weight on the negative data that's been coming in?
I don't know if it's necessarily putting too much weight. I think it's a market which is on edge. As I said, exacerbated by the fact liquidity is so low. But I think that from here, the direction is fairly unclear over the next 3 or 4 weeks. It's going to respond to how that data comes out. If jobless claims moves further up today, then I think, of course, you're going to see a negative market reaction. If it falls back a bit, then the market is going to celebrate. And I expect that to be the pattern of market moves for the remainder of the month until you get into September, and certainly post-Jackson Hole. At that point, maybe you can see some stabilization in a really clear direction for the market.
We also have the DNC next month, and I bring this up because Lori Calvasino is on with Manus, and on Monday she put out a note saying that the S&P 500 has now been positively correlated with Trump's betting market odds, which have been deteriorating, now lag Harris. Could politics be also one of those pillars, one of those reasons why we are seeing the markets whipsaw and we saw that sell-off on Monday?
So I think that the political picture actually played out maybe about 3 weeks ago when you had that huge rotation. I do think that the rotation to a small cap was a little bit about the Trump trade. Things are settled at the moment, but you're right in saying that that election story, it's coming back. It's not like it's disappeared. So come September, I think that is probably going to be, again, near the front of the news story along with the Fed. So we will see that add to the volatility and probably impact the market narrative too.
So if all this about September, should, Danny, John, and I, the last three people left in New York, is all of this just noise then?
In a way, it's noise. So, I mean, the thing that we're advising clients is like, look away from the near-term headlines. It's fairly shocking. The moves are very, very significant. But we have to have, I think the most important thing is to have an idea of what your fundamental picture is. Now, it's still unfolding because you're at that cusp where you could be pointing to a stable economy. And then, as I said before, if job losses really start to mount, then it feeds further weakness. So unfortunately, the narrative isn't as clear as it would have been maybe 6 months ago. But the key point is focus on the fundamentals, because the technicals can really whipsaw you around, but it's the fundamentals which are really going to create that clear longer-term trend.
Seema, that's the story. We've got to talk about the price of the story. And in certain parts of the market, we've had quite a big reset. We heard from Barclays yesterday. They were talking about going overweight tech, overweight financials, looking at buying opportunities. Seema, where do you see the opportunities at the moment? Where do you want to be?
So I think the key area is, look, we still think defensive quality. We know we're going into an economic slowdown. We don't think it's going to be a recession, but it does suggest that you need to have a slightly safer element to the portfolio. We do think that fixed income, I mean, it's really proved its worth in the last few days with that negative correlation returning between equities and bonds. And then within, we've maintained an overweight to large cap tech. We're keeping it at some point, probably not yet, but at some point it will be a buying opportunity as well.
You say we're not in recession, but I have to say in certain parts of this economy, it certainly feels like we are. If you're a low-income consumer right now, it looks and sounds like recession. If you're in manufacturing, based on the ISM we had, it looks and sounds like recession. Seema, are parts of this market firmly in recession?
So you're absolutely right. There are pockets of the economy which are struggling, and that makes sense because remember that the Fed did hike a significant amount in a really, really short space of time. So there will be pockets which will be struggling. Lower income households, the ones that really don't have the savings, that haven't benefited from that passive income, the rise in equity prices, rise in house prices, they're the ones who are most leveraged to the interest rate environment, and that's where the weakness is. But remember, for the US economy, the medium and higher income households are the ones that really carry growth. They account for about 60 to 70% of consumer spending. So as long as they are okay and the lower income households are not really struggling significantly with job layoffs, then I think the US economy, it's slowing, but we're not heading towards recession. But you're right, there is a very, very differentiated environment underneath the surface for the US economy.
Well, Seema, just given the noise that's been around this earnings season, you would assume that it looks pretty bad, that you've had all these companies from airlines to autos talking about how bad things are for the consumer. But Deutsche Bank's Binky Chaja points out that earnings are on track to rise the most in 8 quarters, at 10% quarter over quarter for this one. Do you take comfort in that? I mean, are we overlooking what is otherwise a strong earnings season?
Yeah, I was thinking exactly the same thing today. When you think about the narrative, you'd suggest that maybe earnings picture has been horrendous this season. It really hasn't. But I think the thing is that we came into the earnings season with people, as I said, really worried about what is happening with the growth backdrop, but also looking at the valuations of some of those big tech firms and starting to wonder if they would deliver. So I think that has almost encompassed the entire narrative and hidden the fact that actually under the bonnet, it doesn't look that bad. There has been a broadening out of the stronger earnings performance, and some other sectors, not just big tech, and actually the opposite of big tech, are really the ones who are performing well. And that is a really, I think, encouraging sign for the remainder of the year.
Seema, it's good to catch up. As always, Seema Shah there, Principal Asset Management, talking about what's under the bonnet. Harris Waltz ticket is heading to Phoenix, Arizona for the next stop of their swing state tour. J.D. Vance shadowing the campaign with his own rallies to undercut recent momentum behind the Harris campaign. Tobin Marcus of Wolfe Research writes this: we still think it's premature to consider Harris an outright favorite, which still give a slight edge to Trump. Tobin Marcus joins us now for more. Tobin, great to catch up with you, sir, as always. Scene, just a full aircraft hangar, and it just reminded me of like 2016 and Donald Trump. They seem to be taking a leaf out of his playbook from 8 years ago, Tobin, and it looks to be highly effective. They look like they have some real momentum in the Harris campaign. Yet J.D. Vance is right. We haven't heard Harris answer any questions at all, with the exception of standing on the tarmac following a prisoner exchange. And Tobin, I wonder if that's going to change at all anytime soon, and whether actually it needs to.
So right now, I think they are trying not to mess with the good thing. It's been a very, very, very good 2.5-week run for Harris since she took over the top of the ticket. And I think that they are reveling in the momentum that they're seeing out there and sort of not feeling the need to take any unprompted questions if they're getting their message across, right? The point of the campaign is to deliver their message. They feel like they're doing that. They're getting tons of earned media, most of it positive, but certainly there's no lack of attention. And so I think they are not going to feel immediately compelled to change their media strategy. Although, as the campaign goes on, I do think that we're going to have to see a little more kind of unprompted answering of questions. But I mean, frankly, both Harris and Trump are not taking a sort of press conference forward approach. We're seeing a lot of appearances on alternative media. Trump going on, I guess Kick was the streaming platform that he was on the other week, which sort of similarly is an unorthodox media strategy.
Right, but he also did just sit down with our colleagues at Business Week to talk about a number of policies, something we haven't seen from Kamala Harris. At what point do you think they'll actually come up with an agenda for what their policy plans would be if they win the White House?
Well, they have to put out a platform for the Democratic National Convention, which is in 2 weeks. So we'll see something before too long that sort of purports to be the official agenda of the Democratic Party. And those platforms generally are not that informative about what anyone is planning to do. They're a little bit of an interest group management exercise, particularly on the Democratic side. Trump took a more active role in setting the RNC agenda this year. And frankly, I think it would be wise for Harris to sort of similarly lay out something that's kind of streamlined and reflects what she personally wants to prioritize, rather than some incredibly detailed, 14-point plan on every single policy issue under the sun. So, before too long, we should see her put out something. But, it's a short campaign. The shorter the campaign is, the less I think she's going to have to answer all these tough questions about exactly what's your agenda on paid family leaves. You talk about that. I think probably she can just sort of state a priority for the issue that she wants to focus on and leave some of the details for after the election.
The short campaign works for her, and Washington Post had a story where the former president, Donald Trump, apparently said to someone, "I already beat Biden. Now I have to go out and prove myself against her." How should the Trump campaign be dealing with this? Because we just showed pictures of her rallies. She's getting a lot of people, and there's a lot of excitement around her and her new VP pick, Governor Walz.
Well, their strategy, I think, has always been to portray her as kind of dangerously liberal and out of step with the American people based on her past positions that she took in the 2019-20 primary. She committed to various different things that I think are problematic. One of the reasons why I don't yet consider her a favorite, even though the polling has looked very strong for her, along with that enthusiasm on the ground, is that we haven't really had a chance to see whether or not those attacks are sticking yet. They have not been delivered in the most disciplined way, I would say, from the Trump side. And I think the way that they're intending to tap Walz onto that, sort of attacking nice Minnesota as a socialist hellscape, seems a little bit challenging. But there is plenty of ammunition they have to go after Harris, and we've only started to see that effort come together.
Tobin, that's the content of what they're saying. I want to ask you about how they're saying it. We haven't seen Trump at a rally since Saturday when he was in Georgia. Instead, it's been J.D. Vance, who's been out throughout the Midwest. What do you make of that tactic, that they're basically sending him out to appeal to these voters?
Well, look, I mean, J.D. Vance is from the Midwest. His electoral track record is not particularly impressive in the Midwest. So I don't know how he's going to do as a voter. In Ohio, he ran behind Trump, and he ran way, way, way behind the governor, the Republican governor, who is just sort of substantially more popular figure. So he has some affinity, I think, for that part of the electoral map, but it remains to be seen how effective he is as a messenger. Trump's not been running the most sort of vigorous campaign, more so than Biden back when he was on the ticket. But I think on both sides, we do have guys who are a little bit kind of probably past the peak of their powers in terms of their ability to just sort of run a really, really, really aggressive campaign 5 days a week. So, if they want those attacks to stick, I think they are ultimately going to have to get Trump more out there rather than just posting about her on Truth Social.
Tobin, it just feels like he's trying to beat a man he's already beaten. He's still trying to beat Joe Biden. And Tobin, I wonder why he's finding it so difficult to pivot. We talked about these pivots in the campaign. Clearly the Democratic ticket had to pivot. It's done a great job of doing so. You can see the enthusiasm in the party. You can see that reflected in the polls. Why do you think this campaign is struggling so hard to pivot?
Yeah, so the campaign organization, I think, is pivoting reasonably well. I think if you look at Trump's kind of campaign leadership, they're not feeling too wrong-footed by the need to go after Harris. They feel like they have plenty to say about her, even though, again, that message has not yet come across, and time will tell whether or not they succeed in getting this sort of negative attempt to define her across. But Trump himself, yeah, really does seem to be struggling. I guess there's been a lot of intrigue in D.C. about what exactly is meant by this comma blah nickname that he tries to be, that he seems to be trying to roll out. So it does feel like he personally is sort of throwing some things at the wall and seeing what will stick. Again, we do have 90 days left in the campaign, so he has some time to see if he can make it happen. But for now, not the most effective effort from him.
Tobin, this was great. It's good to hear from you, sir. As always, Tobin Marcus there of Wolfe Research. To look at the totality of the data, joining us now is David Rosenberg of Rosenberg Research. David, we've been looking forward to catching up with you, sir. Let's just take a step back. Totality of the data, as the Fed would like to say. What's your assessment of where we are, David, at the moment?
Well, I still think that we're either in a recession or about to confront one. And, I know everybody's on tenterhooks because of weekly jobless claims numbers, which can quite often contain quite a bit of noise. And coming off what could have been hurricane distortion from the previous week. However, I would say that what's tried, tested, and true is the unemployment rate. And the unemployment rate is up 0.9 of a percentage point over the past 15 months. And the data going back to 1948 show that we had 12 recessions. And when you're up 90 basis points or more in the unemployment rate from the cycle low, you go into recession 100% of the time. So I am definitely not one of those people that would say to you, it's different this time. I don't think that it is. And today's jobless claims numbers, we'll get a fresh batch a week today. Doesn't change my view.
David, I'm going to push you on this, and I'm sure it's something that you have heard multiple times. So I'll give you the opportunity to tell me why I am wrong. The argument of you being wrong goes something like this, that the uptrend is about immigration. Torsten Slok of Apollo out with a note just moments ago saying that more visas are getting accepted, that there's been a COVID backlog, and that just adds again to the evidence that there's growth in the labor supply, hence the uptrend in unemployment. Why is that argument not right?
Well, the argument is partially right, but the reality is, just to go back, the unemployment rate comes from the household survey, not the payroll survey. But the reality is that there's been no growth in job creation in the household survey over the past 12 months. What the data show is that 96% of those people, and I'm sure a lot of them are immigrants, 96% of the people that entered the labor force in the past year have not found a job. Now, I would pose the question back to you. Does that sound like a buoyant labor market as far as you're concerned? This time last year, 96% of labor force entrants were finding a job. Only 4% now are finding a job. So it's not just about labor supply, and it's not just about firings or layoffs, which remain very low. Companies are still hoarding labor, but what are they doing? They're cutting the work week, and they're furloughing workers from full-time to part-time. Well, you get from full-time to part-time, it's not a job loss, so you don't collect an unemployment insurance check. But there are decisive shifts taking place in the labor market right now. So there's been no growth in household employment, and in fact, if you look at the full-time picture, full-time jobs are down on a year-over-year basis. The number of full-time jobs are negative year-on-year. And that does not happen typically in an economy that's still expanding. That's my point.
We heard from Mary Daly recently, and she said firms are not laying off people, to your point there. So why isn't this just normalization? How can we be in a recession if firms are not laying off individuals?
Well, because employment is not just one number. It's the product of two numbers, firings and hirings. And what's happening, and it's not contained in today's jobless claim number, but you do see it in the JOLTS data, and you see it in the Challenger data, which is that hiring activity is collapsing. Like, I don't know what I'm missing. We just got a few weeks ago the JOLTS data. The JOLTS data showed that the number of new hires in the economy, the number of new hires is running negative 9% year over year. And the level of hirings is back to where it was in April 2020. So what's happening is that, yes, the firing rate is remaining very low for the reasons I said before. And a lot of it is because companies have this horrible memory that is lingering about letting people go in 2020 and then not finding them again. So they're holding on to their staff. They're cutting hours, repositioning staff to part-time from full-time, and that's giving this illusion that, yes, firings are very low. But what's happening is that the hiring rate is collapsing. We got the Challenger numbers just ahead of non-farm last week. So in July, the number of hiring announcements in the Challenger data was the weakest for any July back to when the data started in 2004. The number of hires in the Challenger survey is negative 71% year over year. So you're just looking at one side of the ledger, which is firings. But the reason why employment growth is decelerating sharply, even in the payroll survey, is because hiring activity is collapsing even as the firing rate remains very low. That's the story beneath the story.
David, as you know, where there is consensus right now, a lot of people believe the Fed needs to get less restrictive. There's another element to this as well. I just wonder whether you think they need to get accommodative. And when we talk less about the path and whether they go 25 or 50 in September and talk more about the destination, where do you think they're going to end up here at the Federal Reserve?
Well, I think that Jay Powell gave us a ton of information at the podium last week at the press conference when he uttered the word normalization to describe the labor market and the economy no fewer than 11 times. Normalization. So things have normalized. You strip out the nonsense around owner's equivalent rent and the lag nature of the actual rents, and inflation is basically back to target. And the unemployment rate is actually higher now than it was before COVID, when the funds rate was 1.75. So he uttered the word normalization. The only thing that's not normalized is the Fed funds rate. And so what's normalized? Well, according to their own estimates, the neutral rate, the equilibrium rate, the rate that we should have in a balanced economy, which he said we're in, is 2.75. And every Taylor rule estimate shows that today the funds rate maximum should be 4%. We're still 5.25, 5.5. So they are ridiculously behind the curve, no matter what's happening with the equity market. And it wasn't about data that caused the markets to start thinking they're going to go intermeeting. It was, are we going to continue to get 1,000-point down days in the Dow? That was just all about the stock market. But they are ridiculously behind the curve, irrespective of what the capital markets are doing. So he basically said things are normalized, and we do not have a funds rate that is consistent with a normalized economy. So they have a long road to hoe.
David Rosenberg of Rosenberg Research. David, great to catch up, sir. Matt, to Danny's point, we've both been talking about it. Are we going to treat every single jobless claims print every single week for the rest of this summer, the rest of this year, this way?
It's going to be exciting. We're going to be watching for it. It's going to be.
Do you think we should put this much weight on this print?
Yes, because then people want to talk to us about it. So I think we should. We absolutely should. And to your point, it's a very noisy number week to week. You got to look at the trend. But more importantly, at the start of a recession, generally speaking, weekly unemployment claims are sort of 350 to 450,000. So we're still well off the number where we see companies firing and people are getting really concerned about their financial condition. So we're not overly concerned about a recession right now. We're not calling for a recession. Certainly, the market-implied recession odds were way too low a couple of weeks ago, and they're more getting to a place that's more normal. There's a higher risk of recession than zero, but it's still not a base case for us yet.
So what do you make of the levels we're at right now in the bond market?
So for the bond market, as you know, bond guys are like undertakers. We're only happy when everyone else is sad. We've been listening for a year now, all these reasons why bonds don't work, why diversification isn't going to work, why you should have commodities, you have something else in your portfolio. Last week was close the blue book, put your pencils down, the exam's over. Bonds did their job. We've been saying this for a year. We've been counseling getting long duration for over a year now. With real rates around that 2% level, below that now, they can do a job of diversifying. Back in 2021, when they were negative 2% real, right, when they were 50 basis points to 1% in 10 years, yes, they weren't doing their job. Now they can do their job. That was the most important thing we learned from the market, that when there is an economic downturn, when there is real market volatility, treasuries, high-quality fixed income collateral will protect your portfolio.
I look at the past week, though, and I say, yeah, it did a job. They did their job, but in an extremely volatile way. That you saw some big swings in this bond market. Does that dampen their ability to give you protection? That if I have bonds in my portfolio, that it could actually add to some of the volatility in it?
That's a very good question. So Mark Cabana, our head of rates research at Bank of America Merrill, he does have concern about liquidity in the Treasury market. You can flip that a little bit on its head, though. There's no constitutionally guaranteed right to be able to trade a yard at 10 years in a millisecond. So when people realize that maybe the liquidity is not quite there, right, maybe they can't take as large positions, maybe there will be an increase in risk premiums in the market. For our clients who are liquidity providers, who are looking to put money to work, higher risk premiums, potentially because of the bid-ask factors and liquidity you're talking about, is probably better for overall for investors on the whole, because that should lead to a higher term premium, should lead to higher credit spreads on average. They should get a little more compensation for that lack of liquidity. So we are a little bit concerned about it, but from an investor who's providing liquidity to the market, it can actually be a benefit.
Just to that point, do you think this week would have played out differently if it wasn't the dead of summer? If it wasn't August, if this was a couple months ago and all of this was happening?
I definitely think that was a factor. A lot of traders on their 2-week vacations now. August is the new September, it feels like. Definitely there was more volatility than we would have expected. And again, you start to see things in the market like 6 or 7 Fed rate cuts by January seem to overestimate economic weakness. It was more market technical sentiment driven.
So what do you do in a day like today when the markets are basically reacting to this claims like it's a non-farm payrolls because it's illiquid? It's August.
So one of the best things to do is just have your strategic plan in place and take opportunities like this as they give it to you. So we've been saying for a while that, again, we didn't expect a recession, but as we looked across the credit complex, we thought IG, high yield, even munis were a little bit expensive, so we were slightly underweight some of the credit sectors. But we haven't moved to an underweight position on equity. So actually, when we see volatility like this, we've been advising clients to take advantage of it, get back to their strategic targets, put a little bit of money to work. You kind of want this volatility. You want these drawdowns every once in a while to be able to add back to your portfolio.
When you get backups in yields like the ones we've got right now, do you think these are going to get bored? Do you think the last week was a wake-up call for the lazy money, if we can call it that, sitting in money market funds, getting rewarded for doing nothing, and they've been told repeatedly by individual after individual on Wall Street to lock in this yield, this reinvestment risk? That's like been the phrase of this year. Yeah. And then they've sat there and said, I don't know what you're talking about. You've been saying this for 12 months and we've had no rate cuts. Do you think this was the week where that money woke up a little bit?
I would like to think that's the case, but that's not going to be the case in my opinion. As you said, we've been counseling for a year or so that fixed income's longer dated bonds. Cash is not fixed income, it's variable income. You just don't know how long you're going to get that cash yield for. It's going to come down, but unfortunately what it seems like, until the Fed actually cuts, people don't actually move out of money market funds. So we're still going to counsel that. I do think this is somewhat of a wake-up call again, that if you were concerned that bonds couldn't diversify, I think that is taken off the table now. So that will hopefully encourage clients to get back to their strategic targets at fixed income.
Did you just give us a little sneak peek of what client conversations were like this week?
Yes.
Are they still reluctant to do this?
They've been reluctant to do this for some time, which is one of the reasons you know it's the right thing to do. When it's that hard to get people to do it, you know that's probably the right move.
Why do you think this week wasn't enough for them? What did they say back to you? What did those conversations sound like?
So essentially, there's always some new concern why they wouldn't want to move it to cash, whether it's higher deficits, whether it's the fact that they can still get 5.25%, even if they cut 3 or 4 times, they can still get get it. It's very difficult to make the conversation. I try to tell folks the yield curve tries to trick you, right? When yields are that high in the short end and low in the long end, it's trying to trick you, sort of don't fall for it. And again, we don't need to be crazy long bonds, but getting clients from a 2 to 3 year average duration to a 5 or 6 year duration is going to be better for them long term.
It's a big challenge still at the moment. Matt, it's good to see you. Thank you, sir. Matt Diczok there of Merrill and Bank of America Private Bank on the latest jobless claims print.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.